Okay, we had some statistics for employment that came out that everyone's looking at. The basic thing for the unemployment report is if it's not very good, this is getting so tiring. We have to talk about the Fed every week, but it's so important. If there's a good employment report with a strong economy, strong job growth, and low unemployment, that sounds good. That's good for the economy, but it's going to make the Fed raise rates higher for longer. So that is we've been following that formula for a long time now, and so we just have to. I guess the good side is the economy's still doing good. So until we see higher unemployment and lower job growth, we're probably going to still be in the interest rate hiking. I'm surprised it's up like this. Anyone know why the stock market's up so much? I thought that was a bad report for the stock market.
I think that, you talked about the Fed here, but I think it is actually important, the not necessarily the Fed's reaction to it always in the short term, but as the U.S. economy doing well is good for U.S. stocks long term, right? So I think some of those blips, I think it can have an effect on growth stocks versus more value stocks or stocks that are like dividend stocks, right? Like a good economy, I think should be good for dividend stocks because they're going to keep paying their dividends and making money in general.
Mm-hmm. Right. Okay, so we also have to keep in mind that just the idea of selling a rumor, buying a rumor, selling the news, that's one thing. Also, the stock market does the opposite of what the majority of the people in TV think. Because you have to be prepared for, the stock market to do something totally different than the consensus. So, I'm not sure. We're not experts at, interest rates or the Fed. Basically the theme of what we're trying to do here is trying to find some inconsistencies and good stocks to buy at a lower cost and point out stocks that could be in bad shape. Look at this store right here. Bed Bath & Beyond could file for bankruptcy as early as this week. We were talking about that 3 weeks ago. We saw all the red in its estimates. We said that could go bankrupt before it's another event stock again. And so that's an example of some of the ways we could, really triple check some of our stocks we're looking into getting. And here's another article. It says Leon Cooperman. He's a very smart guy, really rich guy. He's very famous, and he says no bull market anytime soon. We had a couple people. I'll go over a couple of reports from prominent people that are saying that this is going to be a lost year, and it's going to be real hard to make a profit this year. Look at some more stories that are happening. I think what's happening with this Bitcoin is it's starting to unravel. These people, these Winklevoss twins, they were 40 billionaires at one point in time, and now it's they've gotten in a problem with lending money through their company, and all this crypto stuff is just out of control. And Mark Cuban basically says that there could be more problems with crypto, with lending, and I don't know. I think it's a good thing to stay away from, if you ask me. Okay. And the other thing is we haven't had, I'll have to start looking more into fixed income because we haven't had a chance to really put together a fixed income part of a portfolio until now. This year we're having 4% rates that are guaranteed, and we never had that in the past 10 years or so. So we're going to start looking into more of those things. I'm going to show you, let's see. Let's look at some of the top performers today in the stock market. Let's see. It's taking a while. Okay. Costco. They had a good earnings report, and so their stock is going up. Let's look at the stochastics on Costco, just because we have that ability here. Costco. Okay, you can see it's in its trading range now. And it's at the lower end of the range. They've had good news. They'll most likely go up to the top of this range next. But we know, because we've been studying it for a while, that 90% of their money is made through their fees for subscriptions, their yearly fees. So that's pretty consistent. And so it looks like the stocks, every one of these stocks in our universe seems to be following. It's going to be following the same pattern as last year, because what it seems like what worked last year is going to work this year. So let's look at let's look at the calendar to see how our investing landscape is turning out. There's a lot of people that say that the recession's going to last all year, but there's the kind of consensus that the end of the recession is going to be around July. And we know from people talking about in the Fed this week that they're not going to start, they're not reducing the interest rates this year. So we were thinking they might start reducing by January of next year. And so this is when the home demand returns, and all the stocks related to homes possibly could start getting into gear around that time. So the other things we think about are, during a recession usually has sideways to lower markets. So that's why I have like at least half the year in yellow is pretty dangerous times. Seems like what's going to work this year is stocks that are paying high dividends, low PE ratios, they have consistent demand that have pricing power. So that's our theme. And slightly higher to flat interest rates. Growth stocks will have lower valuations, going down to a PEG ratio of 1. Safe business models are going to be doing good. The ones that can that have high yields, and you see total. And okay, we're going to keep our eyes open for potentially high addressable market stocks that are filling out with the bathwater. But right now, we're still looking for companies that can raise prices or keep their prices in an inflation environment, and to have profits. Anything that promises profits in the future is going to get thrown away. And, okay, so let's look at our big talking points. The 10-year is down 4% since last week. That's usually good for stocks. And the 2-year is up 1%. Okay, so that kind of cancels each other out. Let's see. So good news for the stock market to go up. China did end its lockdown. They're still having a lot of cases of COVID issues now. But we're currently oversold still. And those are two big reasons. And right now we also have a situation where people sold out of stocks for tax loss harvesting in December, but now it's called a January effect. People buy those same stocks back and try to jump on those same investments again. So that's usually, a factor in the beginning of the year of why stocks go up. And this is like a normal year. January is a good year. We can see that. Let's look at the end of our talks. There, right there. January is usually one of the best months of the year because earnings are starting to come out again, and then we have a couple good months after that. So, but this year is a little different. The first 6 months, we're going to have raising of interest rates. So this seasonality might not work this time. We just know that as the Fed reduces the balance sheet and 92 billion a month, that is like almost like raising it's like raising rates a little bit. So we have to keep that in mind too. And all the Fed said we're going to have like a 5.4 average terminal rate, which means we're going to raise higher and keep it there and not reduce for the rest of the year. So it's going to be flat in the stock market for at least 6 months or so, it seems. Let's see. Yeah, we already covered all this. Let's look at some more things. Okay, so oil is down 6.5%. If we're going into a recession, the price of oil in a recession usually goes down. It's just a simple, not the lack of demand throughout the whole global economy. When demand goes down, the price goes down. And supply is a different thing, but usually when demand goes down, price goes down. So, we're kind of expecting oil will get down to 60s and 50s if there's a bad recession. So, but it's interesting that the oil stock, the energy sector is still doing good, and then probably what worked last year is probably going to work this year until we're done raising rates. Okay, so let's look at, I talked about this, and the dollar index is still going, it's still pretty much going down, where it's in a downtrend. Let's look at, we already talked about that. Right. Look at the sectors and see what's going up and down today in the stock market. The sectors and why. Let's look at change percentage. Everything's doing good today. There isn't a bad sector. The ones doing the best are metals and mining. Correct me if I'm wrong, but as the dollar goes down, the price of commodities goes up. So that could be why gold, metals, so this DXY that we've been following is pretty important. Let's look at DXY. When the DXY goes down like this, the price of commodities go up because all commodities are priced in dollar terms. So that could be why. I'm not sure, but what else is happening here? You have tables.
I think that makes sense. That like the dollar pricing is at least partially responsible for this. It makes a lot of sense.
Because you know what, the dollar has been going up for the past year or so.
But it's been falling the last few months. Yeah.
Yeah. So if it continues that downtrend, that could give credence in us looking at those sectors as possible investments. So you would think the oil is a commodity that would have an effect on the price of oil. There's a lot of smart people right now buying some gold, and usually in inflationary times, gold depreciates, but it hasn't. It's been flat. Joe, you're an expert on gold. Tell us about why is gold acting the way it is? I'm going to pull up gold right now just to check. Joe, do you know anything about gold?
Yeah, I invest much of my profit during the upturn in gold to prepare for the downturn. But I didn't actually buy gold. I buy the gold index and share of the gold mining company.
Oh, okay.
Issue is with gold, it protecting on the downturn, but it probably fluctuated when the federal interfere with the economies and guarantee thing with the quantitative easing. So it defeat the movement of gold for some time.
Yeah, usually, it's like usually it's an inflation hedge, they say, but that isn't really helping out at all here. I mean, inflation's going up and gold is going down. It's not really going up.
In addition, the a cryptocurrency actually come into the picture that can kind of divide the lot. Trader many used to invest into gold. So when crypto come up, they put the money into crypto instead.
Yeah, I guess there are some people that say that cryptocurrency is a safe haven for money, similar to gold. It'll always retain its value, and even when the dollar goes up or down, and it's kind of almost a replacement for gold. But that's I think it's a fallacy. I'm not sure, but let's look at this is the S&P 500 to the price of gold. It's almost perfect correlation to it going back to 2017. You can see S&P has returned a lot better over 20 years, 10 years. It took 5 years. 5 years, it's almost a one-to-one correlation. Because whenever the stock market goes down, gold went down with it. And it's been pretty steady for the past, since the start of the pandemic. You would think, I remember talking to an advisor right at the peak of the crash of the COVID. And he said you put 1/4 of your money into gold. And I said, why would you do that? He said, well, they're printing all kind of money now, and that's how you hedge the inflation, and that basically it's flat after 3 years now. So I don't know. Some of our theories of, there's three demands for gold. One is a reserve currency. I guess most of the gold in the world is held by banks or countries for reserve. Another one is for rings and actual goods, and there's usefulness of gold in manufacturing. So there's certain demands. We don't know about all this, and there's a certain portion of the investing public that says that it retains value over time. So I guess since the beginning of the pandemic, it's flat. It hasn't gone up at all. But who's right? Matthew, what do you?
I was going to say, Greg, I think it might be more interesting here, not comparing gold to the SPY, but to the dollar over the last year or so.
Yeah, I agree.
Yeah. In terms of the other metals and commodities, I think there was a lot of chaos in delivery. I know that I think plastic prices and other kind of bulk goods, which I might include steel. I think that the shipping and delivery was in chaos for the last couple of years. I think some of that's starting to level out.
I'm not sure if this is the DXYN. I don't know. It's just I don't know what. I'm not sure if I have the right symbol here. Is it what is the ETF for a dollar index? Is it DXY? It's not the Dixie group. I know it's private DX. Okay, I guess I don't have a symbol for that. Yeah. Right. Well, I guess we can't do that comparison. It'd be nice, but I guess that DXYN is a company, so it's not really compare. I know what we can do. If you think out of the box there, we'll do XY short. But we have two windows open at once. And I know we can look at this. Okay. We can't do that in Yahoo Finance. We'll do
Try UUP.
UUP, thanks.
UUP is the dollar ETF.
Okay, next. Okay, try that. Comparison. UUP. Okay. It's purple. Let's look at that. You can see the dollar's been going down. So as the dollar goes down, price of gold goes up. It's like an inverse correlation almost.
Yes. So do the 1 year, so the 5 year.
You guys do 1 year. Okay, 1 year.
I think this is more interesting. It's
it is.
they're almost inverses of each other for the last 6 months. There was a decoupling, and at some point they started being straight inverses. Gold and dollars.
Okay, we're gonna get worse. Okay, so that explains. Actually, it's a 1-to-1 correlation.
Which it isn't always. The 5-year chart, you don't see that. So I'm not sure why the last year it's been that way.
The last year kind of exceptional, kind of special case.
Okay, so if we do see now the dollar against other currencies, this UUP, if that continues going down, then material stocks, gold stocks, commodities, oil, ETFs, they're going to continue to go up. So I'm gonna map this out. We're going to keep track of this every week, just because I think this is really useful. That will explain, and oil is a big input to a lot of the products that are made by the companies we're watching. So, kind of nice to make a correlation like that. And I don't know. Would anyone here be interested in a gold investment? I don't know anything about gold really.
I think I would not want a large portion of my portfolio in gold. I've seen people who say 5% or something as I think kind of a alternative to a bond holding or something that you could rebalance with or something. But I think a 25% gold holding would be foolish.
Actually, older generation, the one that not so much into stock, they put all the money and saving into gold, especially the Asian area. Gold is the main vehicle for wealth saving for many families that not really into stock.
Yeah, it's a savings. It's a savings vehicle, right? If you were in principal,
people with not savvy to trading, old generation.
Warren Buffett said he doesn't like the idea of gold because it doesn't produce anything. He likes companies companies that make things that generate cash, generate dividends, and gold basically doesn't do anything. So that's why he recommends not buying it. So it's whatever people are willing to pay for it. So he avoids those kind of investments. So, all right. So that was a good little exercise. Let's go back to the meeting next year. Any more comments about gold? Okay. We go to the meeting next. So let's look at the S&P, where we're at. We're still on a technical downtrend. Lower highs, lower lows. I'm just trying to map out, many downtrends, many uptrends. Seems like right now we're in this mini downtrend where probably this is before today. We might hit this uptrend and then go down here, but there's nothing to break us out of this catalyst. No catalyst really to break us out of this downtrend yet that I know of. And almost every stock we're following is in a similar. The growth stocks are in a similar trajectory, but I'm thinking right around the middle of the year, things could turn around. Where if we're down in the first half, this is the consensus of what you see on CNBC. Everyone on the podcast says, in a recessionary environment, stocks go down or are sideways, and a lot of the dividend-paying stocks are going to go sideways, and the high PEG ratio stocks that are above 1 will gravitate towards 1, and probably mid-year we'll start filling up again. So that's kind of our game plan. Let's see. For me, I'm staying invested because it's just recessions are probably 1/8 of the investing time in our lifetimes are going to be recessions. in 7/8 are bull markets. So you have to put up with this kind of half a year to a year of sideways returns and expectations for profits until we're out of this. So that's kind of the way I'm looking at it. Okay, so the dollar is down again. I guess that's why the sectors called materials are up. Let's look at the ones that are up the least. That's the healthcare, telecom, more conservative stocks. Let's see. It's more of our market movers again.
You still holding the Amazon stock, Greg?
Could you repeat that again?
Do you still hold the Amazon stock?
You know what? That's an example. What I did with my portfolio is I looked at all the stocks that have a higher PEG ratio, and I trimmed or got rid of some. So the ones that had a PEG ratio, like Amazon, is a 70 PE. And the interesting thing about Amazon, the dilemma I had, it's still growing at like 50%. Let's look at that. I trimmed my Amazon because I didn't want a high PEG ratio stock in an environment where those are being punished. It has a PE of 70, but it's still growing at 49%. Let's look at it right now. Two things I want to pull up. One is and you have to do this when you have a larger position in the stock, because you can't just put your head in the sand and say, okay, there it is. Okay, statistics. All right. Okay, here it is. You can see the PEG ratio is 4. And, right now what's happening is stocks are like gravitating towards a PEG ratio of 1 when they're a growth stock. But I have a, kind of a high unrealized gains for this stock, so I didn't want to sell out of everything. I wanted to make sure at least I was considerate for my unrealized gains. Hold on for a second. But the stock is still growing according to this. They're growing at 49%. Let's look at what the numbers are today. Look at the earnings. Okay. You can see, let's go 1, 2, 3, 4, 5, 6, 7, 47% between this year and next year. 3.07 divided by 4.16. Then 27% after that. So they're still growing, and they had a hard time in 2022. Let's look at this. I think what their story was last year, they ramped up and assumed that they would have, all this. They ramped up. People bought a lot, on because they were cooped up at home during the pandemic, and they kind of assumed that they would continue, and they ramped up a lot of employment, and they data centers for distribution centers. Now they're scaling back, so that's causing them to lose some money in this year, and it looks like they're going to continue growing around 30% for the foreseeable future. So that's still 2 times overvalued. So that was my dilemma with that company. But I did scale back, and I sold probably half of my position, because part of our theme here is one thing I should have done, I should have scaled back. Whenever I was saying Apple is it's only growing at 7%, and it was at 30 PE. I guess that the prudent thing to do is to trim back, some of the stocks out there, bigger parts of your portfolio. I haven't scaled back on my Apple and my Google because long term I'm like a believer in those, and they don't have that bad of a valuation. But Amazon was, as you see in this Amazon, the PEG ratio is 5. So that's usually PEG ratio stocks with really high PEG ratio, or they're sold off in this kind of environment. So they're still overvalued, and so I still like the idea of the cloud. And I mean, they're growing in the cloud, not as much as before. And I think the value of the cloud service part of the business is worth a lot. So that's why I haven't sold everything yet. But I did sell portions. Did that answer your question?
Oh, yeah, yes.
Say it again?
Oh, yes, thanks.
Okay, yeah, that's great. Yeah, so I guess the lesson I learned, I should have scaled back. Whenever you have really big positions and you're close to a retirement number, you have to kind of scale out of some of the bigger positions with the extended valuations into something that's a little less diverse, a little more diversified, a little more income oriented. So that was a good lesson learned for me, but I'm keeping some just because I see those numbers and I want to be a part of that. Okay, let's look at some more things. Fed Green Index. We're at neutral. We're like on a border between neutral and fear. They didn't say fear or neutral, so we're going from extreme, from fear of 3 weeks ago to neutral, and the VIX is kind of still in a complacent level. We're not crashing or fearful. Here's a note that I saw from J.P. Morgan. They're seeing commonalities between now and the recession of 1969. And they see a lot of things that are the same as back then. They saw the gap between the 2-year and 10-year, this predictor of recessions happened back then. They looked at the chart back then, and they see us, possibly going through the same 20% correction within the next year. And usually, whenever that happens, the stock market recovers right after. So they're saying it's very, very similar. A lot of they said, let's see, 13% they fell peak to trough during the 1969 time frame, and they're expecting something similar. And so you have to keep that in mind that, if we do have a crash and capitulation, that it's just part of that recessionary, they're taking the money away, and, there's people that wait for this, to sell, and as soon as they sell out, it starts going up again. So when we have that capitulation, we can't be like tricked out of our shares, and we have to make sure that what we're invested in are still quality companies and they're still projected to be growing. Okay, so let's keep that in mind. We have a couple other people saying similar things this week. This is note we mentioned 4 weeks ago. We're looking at Bed Bath & Beyond. This is one of those NEM stocks, and it was trading for $2 a share, like 2 weeks ago, and we were looking at these numbers during our meeting, and wow, there's losses as far as the eye can see. This is the loss per share, and this is the stock price. And whenever you see something like this, and we were talking about this, when it was being bid up, and they just said they had an announcement that they're warning of potential bankruptcy. So that just shows whenever you see look at the earnings estimates and you have negatives and they have a lot of debt, you got to be like super cautious and stay away from companies that are losing money. And we like the ones that are green and in a straight line going up. And so this one is looks like it's going to go bankrupt. This is another example. There was a guy that was on the board of this company trying to hype it. I forget his name, the guy that started the GameStop mania. And he got out of there at the top, and everyone's left with the worthless shares of the companies. And so there are some companies like this, like Tesla. I looked at their earnings projections when they first became public. It was all red, just like this. And their prospectus said, well, we hope to make some money. We're not sure. It's going to be tricky. And whenever that happens, you have to balance the possible total addressable market, whether they have a chance. It seems like Bed Bath & Beyond has no they have no advantage over an Amazon or a Walmart. They have a niche where they give coupons out, and some people go there, but it's just not good enough to overcome the inflationary problems they have right now with. I don't even want to look at the stock anymore, but that's a good lesson learned.
I think a big thing here is that they back 15 years ago they had the wedding market sewn up where if you wanted to like register, that's what everyone did. But now Target and Walmart and Amazon and other companies have really good wedding registry services, and people are using those now. And so I think they lost a lot of that. I don't think that's ever coming back.
Yeah, so I guess that was a niche, and now they're actually losing that. And right, so it's I guess they don't. Yeah, you gotta I guess invest in companies that have that edge or have something that other companies don't have. And I think for Amazon, we were just talking about them. They have scale. They have the ability to buy bulk, and they have a large customer base, and they're the only company that I know of that has their own logistics. They actually fly their planes to deliver their goods. So that is, an example of a moat that Amazon has. But Bed Bath & Beyond doesn't have anything like that at all, and they're losing market share, and they're it's good to study the stocks that are going down too. Okay. All right. Here's some sectors. I get a 1-year chart. I just took this from our stochastic notes. Stocks that will at least, tread water and pay you dividends over the next couple months. And one sector that I looked at was the healthcare sector. It's the XLV. It's paying a dividend, and it's been pretty reliable in this trading range for the past year. And it's towards the middle of its trading range, oversold. And this is an example of a sector where people pay whatever price it is for the health care because people don't want to die. And they have pricing power a lot of times. So, and there's also a lot of people that put off operations during the pandemic, and they're going to start getting those operations and medicines now. So there's still a bit of that that's a positive catalyst for this industry. So, so I guess if you're looking at this sector, look at the trading ranges when it gets back down to here. It's time to buy, and this is not the time to buy. Let's look at some other sectors. I just added this to the sectors we're watching. It's called the Defense, Daily Aerospace and Defense Bull. So DFEN. That's an example of a sector that would do good in this environment because we're spending a lot of money and resources on the Ukraine war, and there's companies that are beefing up their defense. Different countries spending more on defense. So those are all good reasons why this will continue to at least go sideways to pay a dividend in the next year. Utilities. Current example of a people pay their electric bill regardless of cost, and a gas bill, and they pay a dividend. So having something consistent in this environment is, it's going to work, and it's not going to, we're comparing this against risky investments that might go down 20%. So we have something a little consistent here. This is the bottom of this channel, and that's the top. Energy sector. We saw the DXY. I bet you if we let's look at the XLE compared to GLD. Okay, we got the gold. Let's add one more XLE. Let's see if we have a correlation there. So if the dollar continues to go down, is there a correlation? The XLE is the glue. I don't see that same correlation. It's kind of random. Okay, so we didn't make the connection there. Oh well. Okay, fine. That's an added tailwind, they say. If the dollar continues to go down, the price of commodities usually go up. So let's keep that in mind. But it's tricky because if we go into a recession like everyone says, and the price of oil goes down and the energy sector doesn't do good. But okay, that's the thing that I think about there. Pepsi is an example of a stock that they continue to raise their prices and they have continuous demand. Food is everyone wants to eat, and there's consistent demand there. So this is the low end, and that's the high end. But that's and they pay a dividend. Waste management, it's getting towards the lower part of their trading range. If it gets down to here, that's their trading range probably for the next year, because I think dividend stocks will continuously trade in, this pattern. Amgen is an example of a drug stock that's in an uptrend. And drugs are one of the sectors we said at the beginning of the year are going to pay a dividend and have constant demand. And right now it seems like it's on the low end of its trading range. Factor Supply, Matthews Company. It is continuing an uptrend. Started way back in May of last year. So it's one of the ones that is working. Matthew, do you have any idea of why it's continuing to do good?
No, I bought this way back when I thought it was undervalued, and I don't think it's necessarily undervalued anymore. So I'm not sure how to value it actually. So I'm just kind of holding it as something that went well, but I don't have high hopes for it.
Right, let's look at TSVS. Let's look at the earnings projections for that now, just for fun. Okay. And we'll look at just to see where the numbers are on this. Okay, so we look at the statistics. We see it's a PEG ratio of 2, but 4 PE is 21. That means we expect the earnings here to be growing at 10% a year. Let's look at that. Looks like that to me. This looks like 10%. So I guess this is an example. People are paying a premium for things that are growing steadily in a crazy environment. So they're paying double the growth rate. Let's look at what's going at 10.48 divided by 11.47. That's 9%. And let's see, 11.47 divided by 12. 7%. So something is showing 8% with a P of 20, so it's like 2.1 Fed ratio. So I guess the important part, that we learned here that people are, it's a consistent stock. You don't see red anywhere. It's, they're going up in a straight line. When you look at these earnings, you look at quarter over quarter. The best quarter is quarter two because people are planting, I guess.
They're buying mowers.
Doing a lot.
They're buying mowers. That's what they're doing in quarter two.
Oh, interesting.
Lots of bridal mowers, yeah.
Okay, so that quarter two is like, up. But you got to compare quarter one to quarter one of last year, right? Quarter one, and that's going up in a straight line. So you have to make sure that, and it's consistent. It's consistently expected to going up in the coming years. So that consistency in this environment, I think they pay a dividend too.
Yeah, they pay a dividend.
Oh, that's a good dividend. So it's like 1.28. That's 1.5, something like that.
So I think that there are there's competition in the market. There's national competition and regional competition, and I bought them because at the time I thought they had better technology. They were better positioned for order online, pick up in store, and also just order online. But I think there's a lot of that people ordering and coming in and buying more stuff, and I think they're better than a lot of their competition, especially their regional competition. And so I think that they'll continue to have kind of a strong position there as long as they have that better technology. I think it puts them in they don't, they're not a monopoly in the market, and that they have, I think, advantages over the competition. And that's one of the reasons I bought them and continue to hold them, is I think that's probably going to keep being true, but they're not going to take off, I think it's going to be steady.
Who is their national competition?
You wondering what companies are national? I think Rural King is a big one. I don't know if Big R is national, if that's just regional. I'm not sure who else would be national other than Rural King.
Thank you.
Okay, well, they do have a unique set of products that, they have a lot of distributors, places to distribute it. If you can't buy at Walmart or Amazon, it's not practical. They're huge things like food, and you can only pick up locally. So that's kind of their niche, right?
Yeah. So they are by far the biggest national brand. They also run kind of smaller storefronts than a lot of their competition, which I think is interesting. I'm not sure. But they're by far the biggest of the farm store retailers nationally.
Oh, okay. It's a bit Berkshire Hathaway. This is an example of a stock that's largely unaffected by the dollar, and they're mostly domestic companies. So that they don't have any headwinds. They don't have any good things that happen because the dollar goes down. They have they have a lot of their money in treasuries, so they have a lot of cash. But as interest rates go up, they earn more money on that cash. And PayPal is very similar to that. No one talks about this, but PayPal has a lot of money, in reserves. You put some money in PayPal you don't get any money on it, but PayPal actually can earn interest on that as interest rates go up. So the companies that have a big cash position can actually get 4 or 5% on treasuries while they're waiting to use it. So that's one good thing about raising interest rates in Berkshire Hathaway. And they're very diversified too. Boeing, look at this chart. They are one of the ones that are starting to break out. They're starting to get some orders, and if China opens up and they get some orders from China, that's going to be really good for them. Let me see. Costco, we just talked about that. This is last night, but they went up a lot. They're at the low end of their trading range right now, and the next stop most likely is right there. but they're consistent because 99% of people renew their membership. So, and that's 90% of what they make is membership fees. So that will work really good in this environment. And they pay a dividend too. And T-Mobile.
One thing I'm wondering about Costco is that I assume they'll have to raise their membership fee more often if there's high interest, kind of if inflation continues. And that seems like it could be a bad thing for them. Like it seems like low inflation lets them raise their membership fees without less frequently, and people maybe pay less attention to it.
Did they announce a recent member fee increase? I don't remember hearing that.
I don't know.
Not more of a increase, but rather they add more level of service, gold, silver, bronze memberships and stuff like that. So they introduce more level of service.
I think they call it upselling. If you, like for instance, not Gold's Gym. There's a gym that charges $10 a month. What is that gym?
Planet Fitness.
Okay, so that. I'm sorry, guys.
Is it Planet Fitness?
Planet Fitness, right. And they've held that $10 price membership for like 30 years, 40 years. And the reason, and they talked to the guy why he doesn't raise his membership fee. And the reason is that $10 is low enough where people, have the option of going to the gym. It's not that much. And they can say that they're at a gym. On top of that, they have those gold premium memberships. 29% of people go for those premium packages. They pay more than $10 to get in 24 hours a day or whatever it is that they get with that premium package. So I guess Costco's doing that same thing. They're upselling to like a premium. Sam's Club has that advanced membership where you get in at 7 in the morning. That's you pay $60 a year to get that added benefit. So I guess that's how Costco can actually increase their fees and not get a whole lot of backlash from that.
So the Costco CFO did say recently that they'll be doing an increase soon. Yeah. The executive membership does not get you in earlier, but it gives you a percent back, and so it encourages people to spend more at the store and be more loyal.
So something like Amex. Amex is like catered to a high value client, and they give them more rewards, for more spending, but they charge more for their membership fee per year.
And Costco also tries to get you to get the credit card because then you also get more back.
Sam's Club does the same thing. They offer that Sam's Club membership card. A Visa card, but you get more money back on transactions if you buy gas at a certain place. So everyone has their little upsells, I guess. They get a little extra. It's not included in that fee that you pay. So I guess that's one way of them expanding, the money they take in is by upselling different products to them, customers.
Yeah, and so I spend enough at Costco each year that my membership fee gets reimbursed by the check I get back from the discount, the percent back on the membership.
Wow, that's awesome. All right,
I think Sam's is similar too. If you want to go do pickup, if you want to go drive up, pull up, they'll charge you a fee unless you upgrade your membership, and then it's free.
That's like an example of adding services for higher fees. Yeah, interesting. I'm going to breeze through the rest of this. T-Mobile is on the bottom side of this uptrend, and they're having some really good news recently. The T-Mobile shares gained after solid subscriber numbers offer upbeat industrial signals. We're perfectly positioned to properly take further market share in 2023 and beyond. Okay, so this is all pointing to something we've been looking at for a while now. T-Mobile is taking market share from Verizon, AT&T, both of those companies are going to probably reduce their dividends. This one's a growth stock. The other ones are stocks that are losing market share, and they're going to lose customers and probably lose more of their dividends. So this is an example of stock that would do really good this year because it just came out with a really good earnings report. It's at the bottom end of its range. That earnings report will take the stock at least a year. It'll be doing this for the rest of the year. So this is an example of a stock that's in the right place at the right time. And they're actually going to selling internet too. So they're going to sell 5G internet for your home, and that'll eat into profits for Comcast and other major companies that provide internet. So they have a lot of different ways to take market share. And the guy said today, with a good earnings release, all that saying, this is the next stop for T-Mobile.
Anyone use the internet, the mobile provider provided? Wonder how fast it compared to the regular AT&T or Charter internet.
I don't have T-Mobile, but before I had T-Mobile before they took over Sprint, and it was subpar. It was not as good as Verizon. And after I do know from that they took over Sprint, and they have more bandwidth for 5G and for other services than any of their other networks. So they have better networks right now than the other two providers, and they have a lot more capacity. So I think that those two are good signs. I don't know, does anyone else have T-Mobile?
The reason I'm asking because if you compare T-Mobile against Verizon and stuff, T-Mobile had more subscription and probably more reliable network. Well, less coverage than Verizon. But if you compare them against Spectrum or something, T-Mobile is not the cheapest, and the Wi-Fi networking is not proven. Spectrum is very reliable and cheaper.
Yeah, I agree with that one because they sent me a flyer in the mail. I pay a lot less for wireless internet. I didn't go for it because I have something that works and it's hardwired. I'd rather have hardwired than over the air. But okay, so they have. We're going to watch this, and I'm thinking it continues this uptrend. One of the only stocks we're following that is continuously making higher highs. One other note for this: looking for clues to iPhone supply, look at the AT&T, Verizon, and T-Mobile commercials. One of the big tailwinds for Apple is that AT&T, Verizon, and T-Mobile are battling for customers. They're giving away phones or selling them so that you're hooked on their network. And recent commercials, they're basically saying that there are no supply issues. That there are readily available iPhone models for sale now. So maybe Apple went down a lot recently. Maybe the stories are over-exaggerated. I gave a link to everyone the other day about Dan Niles. He's been right on target for the past 2 years or so. I've been following him regularly, and he basically has these things. Don't fight the Fed. As the Fed is raising interest rates, the amount that you're willing to pay multiple-wise for stocks goes down. That's why we're having compression in Google, Apple, Amazon that have higher PEG ratios. And don't fight the fundamentals. And he said that the earnings estimates are going to be going down in the next year, and the stock market prices are going to go down. So in the next 6 months, he says, the earnings and multiples he pays are going down. And he likes the investments in T-bills. So you have, while we're waiting for all these earnings estimates to go down, they're going to pay 4.3%. And he thinks that S&P can go down another 20% this year. And he likes the sectors of healthcare. We've been saying that since the beginning of the year. That's down 4% last year compared to down 20% for the market. And uranium, he says it's a supply-demand issue with that, and there's a high demand for clean energy. So we're going to start tracking the URA ETF, it's uranium ETF. So it's a little out of our scope, but we're going to follow it just for fun. And so he's very bearish. He's trying to be very defensive, and he expects lower prices in the coming year. That's why we have yellow for half of the year, because we're following what he's saying. And this example of the uranium ETF, it doesn't have any correlation to any other ETF we're following. So we're just going to follow it with all the other ETFs. Here's this article from Leon Cooperman. He's a very wealthy and successful person. He says we've had 7 fat years. Now look, we're going to have some 7 lean years. And he basically said that we pulled forward some demand during the pandemic. Now we're going to scale back. And what I did was I wrote down his price levels and where we are right now. He says we're at a 50% chance we're going to be treading market for the rest of the year. 45% chance we're going down. That means we go down to the bottom of this channel. And only a 5% chance we go to higher high. And what I did is I marked that. And one thing that Dan Niles, he has a target price at 300, which is this lower end right here. He says the fair value of the S&P in this environment is 3,300.
So what was his game plan then?
For me, the game plan is...
No, not you himself. I'm talking about him.
Oh, what his game plan is. During this period, while we're going down, he says invest in short-term treasuries. These 3 to 6 month treasuries, that's the safest investment on the earth. They're paying 4.5%. And what's going to happen in the next 6 months is earnings estimates are going to go down. We're going to have bad earnings reports. We're going to have stock prices going down. Like I mapped out, his projection is this orange line there. He thinks we're going to be going down probably to right here, and then afterwards we're going to recover. So he says while we're waiting for a couple months for these earnings estimates to go down and for prices of stocks to go down, we're going to put money into 4.5% yielding treasuries. And in the healthcare, which there's a steady demand. So that's what he was saying. So the other things I wanted to bring up, Tesla slashes prices in China. When we see this news story, we find that Tesla is losing pricing power. And there's a lot of supply from other companies in EV, and that's the key ingredient that they used to have, and they're losing that. And it's looking like more and more like they're going to be turning into a 5% growing company over time. So if they are a 5% growing company in 5 years, people aren't going to pay the premium for it. It's going to be worth like $21 a share. So right now it's growing 20% for the next 2 years, and that's not fairly valued. They're still growing at 20%. But, if whatever happens, increased competition, government might not give as many subsidies. Another thing is Tesla is losing its shine with its owners. They're seeing Elon Musk is something to be embarrassed about, and they're not proud of driving their Teslas anymore. If that happens, this is like a really super expensive car, and if they lose that, that shine to the company, it just may turn into a 5% growing company. We don't know, but that's what's going to happen in 2 years, according to this estimate. I thought that was interesting, but right now the PEG ratio is 1, and that's around. They're growing at 20%. The PE is around 20. So, if everything's the same, if they're going at 20%, then it's a fair value, but we don't know about that. Right, so, so Dan now, he's been right on for a couple of years. I've been following him, so we have to really keep in mind, that he's really bearish for the next 6 months, and he likes the healthcare and short-term treasuries. And here's Dan Mal's S&P 500 level. I backed that to Leon Cooperman's 50% chance. He says 45% chance to here. So it looks like we're going down to 3,000 in the S&P, according to these people. They're pretty smart. But for me, I know what happens is as soon as it goes down to here, if we do end up crashing, it'll bounce up. So don't get sucked in and sell all your stocks. One last comment. I know I'm running a little bit over, but Apple just came out. There was just a note. Someone who really knows what's going on in Apple said that the mixed reality headset could be announced pretty soon, like this year. And Apple comes out with a new product line around every 7 years. There's iPod, the iPhone, and then there's, they always have something really big every 7 years. This is about time for them to do that. And if they do that, that'll add to their advertising, and they have a billion user base that are loyal customers, and that's not included in the 7% growth rate. So right now they're growing at 7%. The PE is 20. That means the PEG ratio is 3. That is really high, and they're super expensive. But for me, it's like a long-term holding, and I believe in the company. They're going to invest in R&D and come up with something every 7 years, and then it'll be growth again. But right now, a lot of things they're selling are maxing out, and they're, you can't really, how many still, I think it's saturated. A lot of the markets they're in right now is saturated, so it's not a whole lot of growth, but they're inventing new things, I'm sure, and they have a loyal user base that's going to use their services. That's the last thing I was going to say, but thanks for attending. If you have any questions during the week, let me know, and I'll try to help, and have a good weekend.
Thank you. Have a good weekend.